Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are in the striking distance of huge event risk. We had a nice Monday here with nothing in particular hitting the wires, markets feeling optimistic, stocks up, everybody seemingly feeling good about what's in front of us. And yet what it is remains tremendously uncertain. All we know is that the calendar has two huge pieces of event risk over the next 48 hours. The first, of course, US CPI inflation data, and that is exactly what we are going to focus on here today, because, of course, what that will lead into the following day, Wednesday, is June's fateful Fed policy announcement, where they are going to ostensibly give us the path for rates over the next several meetings, because not only will they actually deliver a policy announcement, they will also produce their outlook for the rate hike path, as well as their outlook for growth, their outlook for inflation. And that should give us a sense for what the larger story here is going to be for the cost of credit across not just the U.S. economy, but because of the ubiquity of the Fed's steering of the U.S. dollar, which is the global reserve currency, bar none, for borrowing costs and the hurdle rate on really all economic activity the world over. So this is a huge, huge story here developing. And of course, the CPI data will be an input into this calculus. So this is where we're going to start with the obvious question. Will this CPI data greenlight the Fed to keep raising rates? So before we even get into CPI, let's get a sense of what the Fed outlook as it currently stands actually looks like. Here we go. We can see here that as it looks at the moment, we do not expect changes this go around, but the bias is in a hiking direction. So we can see that we have now baked in about 6 basis points of a hike at this meeting, so a pittance, nothing really expected to occur here. But in July, we have 22 out of a 25 basis point hike fully baked in, which, if you look at the number of hikes cuts column on this table here, gives you an 87% probability that we are going to get a hike between now and the end of July Fed policy meeting. That's on July the 26th. So as it stands at the moment, the markets see that hike occurring. And one note here, all of these numbers are relative to where rates are currently. So the current policy setting is 5 to 5.25%. The Fed operates in a range. So it gives you the bottom of the range, the top of the range as the target. That's 5 to 5.25 now. The effective rate is 5.08 as of today. Last I looked anyway. So what we have here then, if you look at the implied rate column, the second furthest from the right, is currently we're at 5.14 for this week, which means that if we're at 5.08 now and we're at 5.14 for this FOMC announcement, then obviously there's no hike. By July, you can see we're at 5.3, which means we've gone past the bounds of the 5.25 current range, and we've arrived into the 5.25 to 5.5 range. We stay there, as you can see, through November. In November, rate cut expectations start to creep into the mix. So what you then see is come December, you're back even. So you've arrived at the likelihood that you're fully priced in for rates back to where they are currently. In other words, whatever hike we're going to get in June, July is fully out of the market come December. And then as you get into January, we're looking at offsetting cuts starting to become actual cuts relative to current settings. So you can see there the implied rate 4.9, which means we're under 5%. And you can see there in the number hikes cuts column, we're at a 67% probability of a cut relative to current settings by then. That's where the situation stands as we head into this event risk. Now, how do we get here? Here's the direction of travel. You can see that over the course of May, the outlook for the second half of this year has materially changed and has become materially more hawkish. So in the dark line, in the blue there, that's June. That's where we are now, right? That's the middle of the year. In December, that's the end of the year. So that's the back half of this year. And the gray bars give us the spread in between those two lines. You can, of course, see with the naked eye that that spread is narrowing as those lines get closer to each other through the course of May. And you can see it in the spread as well. So as of the beginning of May, you were looking at about 75 to 100 basis points in cuts. You can see that right there. So you can see that corresponds to just about 100 or 75 basis points in cuts, so between 1 3/4%. Over the course of May, that's been whittled down to essentially next to nothing. So what we're looking at now is basically standstill, which is precisely what we see here. By the end of the year, rates are at 506. They are currently at 508. So 2 basis point difference. Not exactly anything that looks meaningful. So at this point, we are going to perhaps get one more hike, but ultimately we end up on net between now and the end of the year at standstill. So how does the market look at this? Now, of course, we can surmise before we jump to all of that, that the reason we get this unraveling of rate cuts is because a lot of the risk that was on the table here has been, it seems like, contained. So you see that big decline in policy expectations in early March. That's the SVB-led banking crisis. You can see we fell out across the second half of the year, and really that's where the widening out into a large cutting cycle toward the back half of the year really starts to happen. From there, we narrow a little bit going into about the middle of April or so, as it looks like the Fed has the banking crisis contained. But then, of course, we widened back out because of concerns about the debt ceiling. Not so much a U.S. default, which is a ludicrous thing to price into markets, as we've talked about before, because a market that relies on U.S. government debt as its risk-free asset and relies on the dollar as the currency of commerce the world over, that's not a market that can lose faith in the credit worthiness of the U.S. government, because then those two pillars fall away. Then the dollar, which is backed by the faith and credit of the U.S. government, so backed by fiat, that goes away. U.S. debt backed by fiat, that goes away. Well, and then the market as we know them ceases to exist. So to price into the markets as they exist today, the notion that the U.S. is going to default is an impossibility. It simply can't be done. The current market structure relies on the baseline assumption that the U.S. has not defaulted. So really what has been going on here is the markets were worried that whatever debt deal might be fiscally restrictive at a time when monetary policy is already being restrictive. So might be a bigger than desirable cut in spending, might be some kind of an increase in taxes that's unpalatable that gets done in the deal, might be a delayed deal that gives us a pause in federal spending that ends up being a hit to economic growth. None of those things were things the market thought was likely as of the beginning of May, even as politicians were still debating and the journalists covering them were yelling loudly about imminent default risk, ludicrous though that is. So, with that in mind, you saw this drift all through April of rate cuts falling out of the outlook, where the market said, this is not going to be anything. We're not going to get a deal that's going to be adverse, and we're not going to get a deal that's late. We're going to make it by deadline, and it's not going to be that much of a fiscal drag, so the Fed is not going to need to offset it with all kinds of cuts. Here we are. That's how we get here. The response from markets has been generally positive. If we see here, since the SVB debacle, we've had periods here where first you get the recovery from SVB and policy expectations recover as risk appetite recovers, and the yellow bars there is the S&P. That dotted line is just a 20-day moving average, just to get a sense of where the bars are heading a little bit more clearer. So you can see that going into SVB, policy expectations are rising. That's not something that stocks like, because, of course, that's a higher hurdle rate on investment that makes it more expensive to finance the generation of earnings for corporates. Not surprisingly, not good news for growth. As we get the SVB crisis and both risk and policy expectations crash, and then you get a sort of containment of that crisis, the dust settles, things begin to rebuild, you get a parallel rise in both the yellow bars there, the S&P 500, and the Fed policy outlook by year end. You get a brief pause there as we get some jitters around the debt ceiling, right as you can see here, back half of April. So the red line starts to move a little bit lower. Shares move a little bit lower. That's that second set of arrows there pointing sideways to lower. And through May, optimism. Stocks going higher, policy expectations going higher. Markets are happy. We're not going to have an adverse fiscal outcome here. All is well. So the markets are looking at these rate hike odds improving and saying, this is not bad news. This is good news. This is digestible. All is well. This is the baseline. Ostensibly, this baseline includes the idea that likely in July, we are going to get another hike. That's where the market default is now set. So this is the backdrop against which we are going to look at what's happening over the next 48 hours and then surmise what happens next. Now, CPI. Here is the makeup of what is happening on the U.S. inflation front. Now, the numbers you see there in the red boxes there, the red border boxes, white inside, as it were, is the expectation numbers. You'll notice they poke out a little bit past the components because, of course, the components will need to be updated with these releases tomorrow. But you can certainly see the direction of travel. Headline CPI expected to come down to 4.1% from 4.9. Core CPI expected to come down to 5.2% from 5.5. So ostensibly, disinflation continues. What's interesting is that the biggest component of disinflation here over recent, let's call it months to a year, has been the squeezing out of energy prices, which at this point are actually a negative influence on CPI, despite the energy minister in Saudi Arabia with that surprise production cut telling us that we're going to be ouching ostensibly because energy prices are going to go up. Well, not so much here. Obviously, we can see energy being completely squeezed out here as a positive contributor to the whole CPI story, and the orange area there, the goods area, being squeezed to next to nothing as well. Food is about steady, but the big question here is services excluding food and energy. And of course, services are the biggest component of the U.S. economy. It's close to 3/4 of all employment and economic activity. So this is really the big story, is what's going on in services. And this is where disinflation will need to happen. Now, not surprisingly, the biggest question in services is labor. And we'll take a look at that momentarily. But the question first is, if the Fed has to make progress on this services component, is it on track to get the number moving further from 4.1 down to what is the Fed's objective of 2? Now, the Fed looks at this in terms of the PCE index, so that's going to be a little bit lower. The last spread is a difference between about 0.5%. So the last April PCE number was 4.4, CPI was 4.9. So there's a little bit of a gap there, but you can very clearly see that we have about 2% or so more of disinflating to be done. And so the question is, can you work down that services component? Because that's easily the biggest part of this story. Food inflation is not an insignificant wedge here, but you can see it's much smaller than what's going on in the services contribution. And there, we've looked at this before. There's been a little bit of a divergence in soft commodities. They've been going higher, whereas overall commodity prices have been going down. So perhaps there is a bit of a stickiness in food inflation here. But it's really that services component that needs disinflating if the Fed is going to be successful. Looking at the latest set of ISM services numbers, then, it would appear the Fed is heading in the right direction. We can see the prices component of services PMI in the latest ISM figures shows us continued slowdown. In fact, we are approaching the slowest pace of price growth since the lows during the onset of COVID, initially at the start of 2020. And we're well down to price growth before the pandemic. So at this point, it would seem like we're heading in the right direction. We can see this ISM services number tends to lead core CPI by about 3 months. And so we can see that, indeed, core CPI seems to be complying. It's not quite going in perfect unison, but the general sort of outlines of what's going on here seem to line up. And the path forward seems to be already paved. Now, the question is, how is that going to occur? What are the forces that are going to get us there? And not surprisingly, as the makeup of CPI seems to suggest, it isn't through improved efficiency. This was the part of the story that dealt with supply chains, disruptions post-COVID, all of those things that the Fed was arguing into the end of 2020 and the beginning of 2021 was going to be the reason that inflation is transitory, that it's going to go away by itself, that once you improved supply-demand disconnect from supply inconsistency, the price was going to come down because, of course, why do prices go up in that scenario? Lots of people want things, and those things don't consistently get to them because supply chains are wacky. And if that's what's going on, then those people compete to get a limited supply of things coming in on price, bid the price up, things cost more. That part of the story appears to be done. If you look at shipping costs, that's the Baltic Exchange Dry Index here, they're back down to pre-COVID levels. If you look at the latest PPI report, and we're going to get an update on this later in the week, but if you look at where it stood most recently and where it's been going, the cost to move goods around, so in other words, the level of expense to traverse these supply chains, both for intermediate goods and for final goods, has completely fallen off a cliff and is now holding near levels that are well within the range, and indeed the lower part of the range for the pre-COVID economy. So it would seem that there is no more juice to squeeze out of supply chain efficiency here to get 2% more out of the inflation number over the Fed's desired window, which is give or take 2.5 years here. So where is that going to have to come out of? Well, ostensibly, it's going to have to come out of slowing economic growth. If you've exhausted everything that there was to do on the supply side, and supply is coming in a way that is consistent at this point, and the cost is not something that is being bid up because supply is disrupted relative to demand, well, now you need to cool demand relative to supply. Because given supply, you seem to still have more demand than is consistent with prices declining to a 2% level. Hence, here we are. You can see that in Spain, when you look at the mismatch between labor supply and labor demand. The way that we're doing this math here is we're saying labor supply is the labor force as it stands currently. And of course, we just got this update from the latest set of NFP numbers. That's the number of people currently working, plus the number of people looking for work. So the number of the employed and the number of unemployed. Very importantly, you're not unemployed, statistically speaking, if you're not looking for work. So what this is looking at U.S. Bureau of Labor Statistics numbers and saying how many people are working, how many people want to work. That's the supply of labor. If you look at the demand for labor, it's the number of people currently working. So again, the employed number, and then the number of job openings. So how many more people do businesses want to work? And you can see that there is still a big, big gap. And worryingly, for the first time in 4 months in May, that gap widened as job openings ended up being greater than anticipated and actually unexpectedly jumped back over the 10 million mark. So you can see here the very latest bar on this right there. That's the first increase in 4 months. So ostensibly, things are not exactly going in the direction that the Fed would like. Now, granted, it's only 1 month. But, not surprisingly, there is a question still here because you can see the gap, even in aggregate terms, is much bigger still than it was before COVID. And part of that, of course, is demographics. We've had an exit of baby boomers from the jobs market for some time now. It's been accelerated significantly by the pandemic. We can see the mismatch is still huge relative to recent history. And so whittling that mismatch down is really what this story is. And that's a story of trying to squeeze the economy hard enough that demand weakens. And the pull on what is now consistently delivered supply is reduced such that the price of that supply has to be cut so that inventories don't linger and markets clear, which is how you get the disinflation ostensibly, that the Fed is after. You can see that sort of dynamic is well underway already. So what I have here is sort of a proxy for global economic activity by way of trade. This is the cumulative total of global trade volume, imports and exports. And you see that with the Fed's tightening effort, you are driving down global growth. So overall economic activity is declining. And with it, so is CPI. So we can see exactly what the Fed is aiming at here. So ostensibly, these numbers shouldn't worry markets. This should, in fact, be, as we see now, a relatively rosy situation, which presumably is why the market is cheering, even though we have one more rate hike in the offing, seemingly, and why the market is relatively sanguine about what's going on here. But not all is necessarily as it seems. Because what the Fed has perhaps a bit of an issue with here is the direction of travel. It would seem like we're next to priced for perfection here. But of course, if you're priced for perfection now, relative to what's going to happen in 2 years' time or even 1 year's time, well, then you really don't have any margin to get anything wrong. And of course, nobody has a crystal ball, and there are ample risks left. So, consider. We have not had meaningful movement on inflation expectations, really, for the better part of 8 months. So they've been relatively benign. If we look at various ways of looking at inflation expectations here, I have two on the chart here. The yellow bars are the 2-year break even. That's the difference between U.S. inflation adjusted and nominal bonds. So the TIPS yield over a 2-year period and the nominal U.S. Treasury yield over a 2-year period. If you take the difference between those, you get as your residual the value of that inflation adjustment that gets you from the nominal to the real. That's your inflation expectation over the 2-year stretch as implied in bond markets. So not some economists' forecasts, but what the bond market actually is saying. That's at 2.1. So ostensibly, all is well here. The Fed is going to get basically to its target within 2 years' time. Even more encouragingly, most of the work is going to get done within a year. Looking at the 1-year US dollar inflation swap here, we can see down to 2.3%. Now, of course, these are different instruments, so there's a bit of a difference in the way that they're going to reflect things. It's not necessarily one for one, but you can see here the bulk of disinflation, according to markets here, is going to happen within 12 months' time. But the expectations haven't moved any in quite a while. So even as you get continued disinflation expected on CPI, which tends to lag these forward-looking measures, market-based measures, by about 2 months, you've stopped moving on expectations, which means the markets don't think that everything that's going to happen basically from here going forward is going to be any more disinflationary than what is already there. Which means what they're betting on is that the cumulative impact of Fed tightening will be sufficient in what is already done, and this one last hike now baked in for July, that will be enough to bring us to target. Just so. And if anything inflationary were to happen between now and then, well, then we're off target. Because we've just placed a toe on that target here. And it would seem that we are but one unexpected thing away from being off it. Now, maybe that's a comfortable place for the Fed to be. Or maybe it's not. And what we learned from the Bank of Canada last week is that, at least for their part, they are not. Consider where we were going into Canada's rate decision last week. Much the same story. Disinflation ongoing from 8.1 to 4.4, but expectations idling. Idling on target, but idling over about the same sort of period as what we see here for the Fed. Now, how did the Bank of Canada react? Well, going into last week's meeting, its calculus was very similar. It had a full rate hike baked in between June and July, and the market was firmly tilted toward July. Bank of Canada raised rates and surprised markets, gave us a pop in the local dollar, but more importantly, it gave us a pop in US yields, as well as the Fed policy outlook. As if to say, well, if Canada is going to do it, if Canada feels that it is too close to comfort here, that it wants inflation expectations to be falling, to give itself some margin of error here to land things over a 2-year window, lest some unexpected developments take it off target and then it finds itself behind the ball again. What does that mean? Well, if Canada has decided that economic growth is too hot, which is what it said in its statement, and 73% of everything that Canada exports is to the United States, most of the population lives within a stone's throw of the U.S. border, and most of the provinces ostensibly have a relationship closer with the U.S. in terms of economics than they do with each other. Well, then, the natural thing to conclude is that the reason Canadian output and Canadian growth looks too hot is because U.S. output and growth is too hot. And U.S. demand is not sufficiently constrained for central banks to feel comfortable. At least the Bank of Canada didn't feel comfortable, and the market seemingly concluded, well, the Fed shouldn't feel comfortable either on this logic. And so as we then consider this, we think, okay, well, if the number comes in for inflation at 4.1 as expected, does that move the Fed's needle? Not really. Does it move the market's needle? Well, not really. We still are in this sort of state where we're idling on inflation expectations. Might that then mean, unless there is a meaningful downside surprise on inflation that reignites expectations moving lower, that the Fed needs to do something to get them to do that? And with a similar calculus as the Bank of Canada, where the market is already anticipating a hike, it's just anticipating it later, might that then open the door for a hike that's sooner, a mere 24 hours later? It could be. And if that's the case, what does that mean for this calculus here? Well, it would ostensibly mean that we might end up higher than we thought by year end. So expectations might nudge up, but risk would then be met with a adjustment in its baseline expectations that could very well force it lower. Now, we could have limited follow through because, of course, we have a situation where the Fed is the very next day, and with CPI out in front, it seems difficult to imagine that markets are going to jump out the window and fully find follow through ahead of what is a much bigger event risk. And of course, CPI is an input into that event risk. So why look at a secondary indicator as your primary source of direction when you're going to hear from the horse's mouth within a day? So the response could be muted, but that need not mean that it won't be stage setting for what the Fed might actually do the following day. And if a strong CPI number comes out, or even one that's roughly in line with expectations, if it doesn't miss by a meaningful margin on the downside, and risk wobbles, even if it doesn't wobble in a lasting way, if stocks dip on that outcome, then we might get a preview there of a Fed that comes out the following day risking a more significant risk-off outcome. And that is Macro Money for today. Thank you very much for joining me. I'm here Monday through Thursday every week, just after overtime, which is a show where Chris Vecchio, head of futures and Forex, and myself break down the day's events and try to make sense of them after the U.S. close. I'm also on with Chris for Futures Power Hour on Fridays, and on with Tom and Tony for First Call on Sunday evenings. Outside of those shows, I'm writing, of course, for the Tasty Live website, so you can check those articles out there, and opining on Twitter, where I put out all of this stuff, the articles, the videos, so you can follow that, at Ilya Spivak. Good luck trading out there, everybody. We'll talk Fed in more granular detail tomorrow. In the meantime, good luck out there. Take care.